The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus podcast, and kind of getting a little bit of a pattern going here where I'm getting some friends from a mastermind that we're all mutually in, which is just super powerful. It's a capital raising mastermind that, amongst other things, is just networking with high level folks and that are amazingly resourceful and connected and talented. And today's guest is one of those just perfect examples of that sort of entrepreneur. Chad Zdenek. Oh, Chad, I got it wrong already. Chad Zdenek, right?
Yeah, there you go. You got it.
Zdenek. It just had to come out a few times. I knew it. That's the thing. I could spell it. I just couldn't say it. But Chad is with us today, and Chad is really an expert on a lot of levels in this business. And we were talking just a little bit off air about how we can kind of bring the most value. And I think Chad's story and his experience and track record in particularly the passive investing space in both multifamily and self-storage is going to bring quite a bit of value. So one interesting point, and Chad, I'd like to hear a little more about this at some point, is he boasts that he's one of the rare investors who invests both in California and outside of California. So what that says to me is that, man, if you're playing that game, you got to really know your stuff. So Chad, super stoked to have you on the show, man. Thanks for being on.
Yeah, me as well, Tate. Super excited about it, and glad to have met you through Raise Masters. It's a great group. So Thanks for having me on the show.
Yeah, appreciate it. Yeah. So just diving right in, tell us about Chad's story. And you're a general contractor, you're an engineer, you're a former CEO, triple master's degree. You're kind of an underachiever, but it's really good to have you on the show nonetheless. You're very impressive. So tell us your story, Chad.
Yeah, I guess the story's been meandering for a while. I guess maybe about 25 years now, but yeah, definitely an underachiever, continually trying to improve myself and learn and whatnot. So it's, just never rest on my laurels, as I know you are and a lot of your listeners for sure. But yeah, so for me, I've kind of had three distinct chapters in my career. The first chapter, I was a cubicle jockey working at Rocketdyne, technically a rocket scientist working on the space shuttle main engines. I did that for 7 years, worked with incredibly, brilliant, smart people. And then I went and helped my brother grow a new business, which was a lighting business here in LA. We did that for about 17 years, actually, and grew that to be about 75 employees, 3 different warehouses. And then he bought me out in 2018. And I like to say I went back into real estate because I was in construction beforehand, doing construction management type stuff. Like you said, got my general contractor's license and really getting back into real estate, but on the investment side, which has been great. I love real estate. I love combining real estate with entrepreneurship. And that's really kind of what I've been doing since. So if you look at these three different sections I'm talking about, the first section was very much, working for a Fortune 100 company. Like I said, cubicle jockey. My hours were from 7 a.m. to 4 p.m. I had no flexibility. And actually, this was a good one for the Gen Zers out there. I actually had a 7:15 a.m. meeting every morning. So I had to be in the office by 7:15 a.m. morning meeting. And that's what I did. I had no flexibility. So then I'm like, okay, I want to have flexibility. I want to own my own company. And so I did that for 17 years. And I learned what it really meant to the question, why would you want to work 40 hours for someone else when you can work 80 for yourself?
Right.
And, 80 hours was like a light week. I got up to like 120-hour work weeks, and it's just brutal growing a business. And I made good money. I had somewhat flexibility in that I could kind of decide more or less when I wanted to work, but it was a ton of hours, right? So really still trading time for money. But it was a lot of time. And then comes real estate, and real estate is really like what I see as like the pinnacle of this career, if you will, where I'm investing in hard assets, preferably cash producing assets, which I know we're going to dive into a little bit on the show, the passive income side of things, and doing that through real estate with tax advantaged investments. And that's been a great third chapter of the career, and something that's been really lucrative, really enjoyable, still continuing to grow and network and do all those sort of things, grow a business, which I really like to do, which is for me, CSQ Properties. You can see over my shoulder here. So it's been a great journey for sure.
It's awesome. It's a great story. Like you said, kind of three different chapters of being the employee, being in that world, and to some degree, I would think that mindset, but you obviously saw, the opportunity, like you said, working 80 hours for yourself and, or 120 hours for yourself, and building that business for 17 years, man. That's a long run with one business. Congratulations on that.
It was a long run for sure, but I really enjoyed it. It was, like when you grow a business like that quickly, like every year, it was a new business, right? I mean, it felt like a new business because we had so many new systems and processes we were implementing. We were adding on staff. So really the company was evolving at a pretty quick rate. So it was definitely challenging and different each year.
Yeah, gotcha. Before we kind of get into your real estate journey in depth, like, what did you take from, like, two questions. So what did you take that was super like essential to the next chapter from, well, let's start at the beginning. Let's from your workforce, corporate job, Fortune 100 company job. What did you take from that into the 17 years of killing it in the lighting business? And then from there, like, what have you taken from that into real estate? I'm curious if there's a thread.
Yeah, there is actually. And I guess a few thoughts on it. So the first transition from, working the 7 to 4 or 9 to 5 job, at a big company like that, I really learned a lot about processes and systems and kind of the importance of having that. So like you could rely on the system a lot more than the people per se. The people are still really important, but in order to grow and scale, you've got to have that backbone infrastructure of systems. And so I'm an engineer anyway, so like I'm kind of naturally inclined to use systems and appreciate systems. Mm-hmm. But I got to see it in action at a very large company, and then I went from that to being in a company where it was just me, my brother, and a few workers, right? Like really, really, really small company. Mm-hmm. And but as we grew by implementing systems. And so I saw really the importance of that. I got to kind of witness that, firsthand experience that, which was great. And then, but I've always been an entrepreneur, even since before college. My whole life, I've been an entrepreneur. So I kind of tapped into that with the lighting company. And then when I got into real estate, I knew I wanted to get into real estate just because I'd met so many people over the years that were really successful in real estate. It's been said that 90% of the world's millionaires have a portion of their portfolio in real estate. And that's a part of how they've become who they've become.
Yeah.
And so I always wanted to get into real estate, but what I didn't realize was really how entrepreneurial real estate could be. And for me, that's really like been a blessing in disguise. Like, I don't know why I just never thought that the two would merge. I just kind of saw them separated. But ever since I've been, I started my business, I've been growing it. I realized that even in real estate, something that, is like tried and true forever, it can still be very entrepreneurial. And for me, that's like a win-win. I've got the investment side of things. I got the passive income side of things, but I get to apply my passion in entrepreneurship to a real estate company.
Yeah, I can relate. Well, to me, ultimately, it's all like, not to get woo-woo or like too worldview, but it's like ultimately it's all spiritual. And to me, like the entrepreneurial venture is the opportunity to really like use those tools at that level and bring purpose and passion into your world. And then to integrate the systems, the processes, just the hard work ethic and everything else. It's for those of us that are kind of wired the way I think you and I both are to some degree, like it's such a fun space to be in. And I'm with you, like the entrepreneurial opportunities, whether it's thought leadership or being a different part of different deals, like, limited partner, general partner, different roles, or, just growing a company, right? Like it's just a wonderful opportunity. And I'm so grateful that we get to do it every day.
Yeah. Yeah. And maybe if I can, I'd just like to add one thing to it, in kind of a distinction between entrepreneurs and real estate, even though you and I are both in the entrepreneurial real estate space.
Sure.
We know a lot of people that run businesses, start businesses. They've done really well. I'm actually a part of the Entrepreneurs Organization, which I've been a part of for 10 years. And there's 17,000 business owners worldwide as a part of this group. And I've learned a lot from these people. But one of the things I've seen is like the entrepreneur, some of them can build a business that kind of runs on their own and it goes off, right? And they can go off into the sunset, do whatever they want. But that's a very small group of people that actually kind of make that type of entrepreneurial business, right? Most entrepreneurs, like they're in their business day in, day out. The business goes ups and downs as any business would, but they're very much working in the business, even though they might have a staff or large staff and make good money. But they've got to be in the business, right? Like if they left that business, a lot of these smaller businesses would cease to exist at that point. So now you have an entrepreneur who's got flexibility with their schedule, but they got to put in a lot of time, and they're still kind of handcuffed, if you will, to the business itself. And that's why what's really important for me is to try to like share the story of real estate with these people. Like they can still do their entrepreneurship. That's their passion, right? Like they think, 24/7, they think about this business. And I try to say, okay, good, go do that. But on the side, acquire some real estate that's going to peel off some passive income for you over time. So that when your business goes through those cycles, you have some real estate that you can lean on, or the passive income from real estate that can help you out. Or B, if you ever sell the business or shut the business down, or God forbid it goes bankrupt, like you have a whole different asset that had nothing to do with your business that can help provide a safety net for your family later on.
Yeah. And it really segues perfectly into, like you described so well, Chad, the active entrepreneur, right? Like you said, that in a lot of cases, like the business is you, right? Like depending on your business model, like I was a professional photographer for 10 years and weddings and portraits and professional ski photography. And I couldn't leverage another person. I mean, I could, but it was me that everybody wanted to hire, right? I was the product. And I think a lot of like YouTube personalities and entrepreneurs that are driving traffic through funnels and stuff like that. You're right, man. It is like there aren't enough hours in the day some days, right? I'm sure you know that very, very well. And you'd buy another 4 or 5 hours if you could. But I really appreciate that you made the distinction because it, like I said, it segues really well into the opportunity with real estate to own, like you said, cash flowing real estate, passive, that's producing passive income, ideally is appreciating in, depending on the type of market that you're in, the type of asset that you're in, but almost always you're predicting some appreciation in any pro forma model. And then you mentioned tax advantages early on, that's almost a whole conversation unto itself. So all of these advantages into owning real estate. But so when you go to these entrepreneurs and have these conversations and kind of start to create these possibilities with them, my thought is they would be like, dude, I am so busy with what I've got. How am I possibly going to own real estate that's going to pay me passive cash flow with everything else I've got on my plate? What's your response to that?
Yeah, and that is a common hesitation amongst a lot of entrepreneurs. The other challenge is, and we spoke a little bit about this earlier, like entrepreneurs like to know everything about what they're doing, right? Yeah. And if you're too busy working 80 hours a week on your business, like you don't have time to learn anything else, right? You just don't have time to do that. But yeah, it becomes a mindset shift and maybe a little bit of an awareness kind of learning process where, hey, there is this whole different world called passive investing or limited partners of these LLCs. And it takes actually very, very little on the part of the investor. In fact, I'd say 95 or 90% of what they need to do is just upfront work, like research, like, okay, what operator do I want to invest with? What kind of asset class am I interested in? What areas am I interested in? Like those big questions, like once you answer that, then, and you get into a deal, it's very, very little work. I mean, you look at financials if you want to quarterly or annually, you might read an update here and there. Like you just don't have to do any work, right? That's what you're partnering with the general partnership team to do. They do all the work, which is why it's critical that you trust them and you know them well, because they're the ones that are managing your investment. Mm-hmm. So I try to explain to entrepreneurs, like, you don't need to put in a whole lot of time, just put in enough to feel comfortable up front. And people have different levels of, how quickly they can get to that level of comfortness. It varies greatly. Whatever it is for you, figure that out, get comfortable, and then make an investment and then let it go. You're right. Go back to focusing on your business. And like you mentioned earlier, you do have the cash flow, but a lot of times you also have the appreciation over time, whether that's market appreciation just from market forces, or you have forced appreciation from like a value add or rehab type project that's going on. And you can force appreciation as well. So, and then usually you'll experience that during a refinance event or when you sell it, and you get another, pop on your investment, if you will. Yeah. So that's really what I try to encourage people to do.
Mm-hmm. Yeah. And it seems so intuitive that it's really, like you said, it's really in the setup for these passive investors, for them to get comfortable with the concept, the structures, how payouts are made, how distributions are made, how profits shared at the end, all that stuff. Are there any resources that I know you've got a great ebook? Maybe you could talk a little bit about that, but any other resources that you point people to, to kind of start from square one, say a guy's, killing it in making soap and distributing it all over the planet. It doesn't know a thing about real estate, just as like a drop shipper, basically, right? Where would somebody like him start?
Yeah, I mean, look, I think, listening to podcasts like yours is a really great spot. I know, I have my own, we put in a lot of time into curating guests and trying to dig out some information that we think will be helpful. I know you've had a lot of, well-known guests on your show. And I think that's a great way to learn, right? You got, like anything else, especially in the podcast digital world, like you got to take it with a grain of salt. Like there's some stuff out there that I don't know if they're untruths, misinformation, but you just got to be careful, right? Especially when you're like speculating about like which direction the market's going to go, right? Everyone thinks something different. So it helps to kind of listen to all these different perspectives, and then you start to form what you think. And so I think podcasts are great. There's tons of YouTube videos are great. Mastermind groups, which is probably too big of a lift for the audience that we're talking to right now, meaning joining a mastermind group to be a part of it. EO is a great example because you're just networking with other entrepreneurs, and then you find someone who's doing real estate, right? And that might help make you feel more comfortable. So there are mastermind groups that could actually help you in your business, but there also might be an element of real estate there. So I think those are probably the best ways to start to learn. And the last thing I'd add is if there's someone that you think you're interested in learning more about, or like an operator, because that's really where it's going to start, like your sponsor, your operator of the deal, get on their email list, right? Start following, tracking their projects, and watching their updates and seeing what they're doing. Like there's a lot to be had from just learning and following that sort of thing. And you've got no money on the table at that point, right? You're just learning and listening and watching, and that can make a big difference.
That is so smart. Like, go get on 20 syndicators' email lists and just watch all the resources that get sent your way in the way of, automated email campaigns that are almost always highly educational, value add, really tailored specifically to where you are, getting your feet on the ground with that syndicator, with their investment thesis, with their culture, with their buy box, everything else. And just start learning the language through that. And like you said, podcasts like this, there's on the passive side, Apartment Gurus has been, we were talking a little bit before the show, Chad, about it's been, heavily focused on kind of the owner operator, lead sponsor, general partnership side of things, because that's what I've done. And so I've shared largely from my journey and obviously related to guests a lot through that. And so it's an awesome opportunity to have you on the show to kind of shine the light into this passive side, because we do mention it a lot, especially in terms of opportunities that we have a Greenlight Equity Group, which are almost always 506c opportunities, which means we can talk about them on the show and whatnot. Accredited investors only. So yeah, and I appreciate that the email list suggestions so much, because there's just so much that you can learn, and spending 5 minutes on somebody's landing page can really get you very, very familiar with that. So speaking of that, before while we're on this, what's the best way for listeners and potential passive investors and whatnot to get in touch with you?
Yeah. So for entrepreneurs, I put together an ebook on why entrepreneurs should invest in apartments. And it's very specific to the entrepreneur lifestyle, if you will. And that's a free ebook at passiveinvestingentrepreneurs.com. That's plural. So they can download a copy there. Also our website, csqproperties.com, or anywhere at CSQ Properties, which stands for Challenge the Status Quo, by the way. You can find a lot of stuff there. But one thing I'll say, going back to the passive investing or passive investor, and you've probably experienced this as well at Greenlight, but like I've had investors that just kind of like follow or learn, and like it takes a long time for them to just kind of see what CSQ is doing and then get comfortable. Eventually they'll invest. Some of those investors, so they put up a lot of time up front just getting to know me and see what we're doing, right? And then eventually they just want to keep putting money in deals, right? And like I've literally have secured $100,000 plus investments from a couple text messages with these people, right? They're like, they already know me, they know what I'm doing, they've gotten returns on other projects, they're getting monthly cash flow, like they like it, they know the story, and I'll let them know, or they'll see that I've got a new deal coming up. And then they'll text me. They're like, all right, what is it about? Right. And I give them like literally like 3 sentences, and they might ask a couple follow-up questions, and they say, okay, yeah, sign me up for 100K. And it can get that fast, right? If you've been in the game for a little while as an investor, and you know what you're looking for, you kind of figured that all out, and you find your general partner that you're comfortable with, it's actually a very, very quick and easy process down the road. It doesn't need to be daunting every time. You don't need to recreate the wheel and do all this stuff. I mean, that's what us as GPs get paid for, right? We get paid to do the due diligence. We get paid to find the best financing possible, right? We get paid to manage the properties. All this stuff is what we do. The limited investor should not have to do that.
Right. Yeah. And it's, at some point, the limited partner, the limited investor is investing in the general partnership at the end of the day. Right.
Yeah.
That's the final call that you're making is this group going to do what they say they can do? Right. And so you want to look for, I'll let you go into that. What in a sponsorship team, how do you coach people to vet sponsors?
Yeah. So I like to tell people that there's no project or no deal that doesn't ever have any issues, right? There's issues at every single project.
Yeah.
And that, frankly, that's kind of what I like about real estate, right? It's every deal is different. I was just thinking about this. I was actually on a panel this last weekend with Ken McElroy of all people. I don't know if you know him, but it was kind of cool to be on a panel with him. But, I told people, like, I've actually never done the same deal structure twice. Mm-hmm. It's always been different, which is kind of unique. I hadn't thought about that before, but the point is that they're all very unique deals, and there will be problems that come up, right? The question is, what is the experience and the wisdom, if you will, of the operating team to manage that, right? Have they gone through things that have been similar issues? Do they have a strong network to kind of lean on people if they need help on something? Do they have the deep pockets to kind of weather some of these storms? Mm-hmm. Right. Like those are the questions or the things that the GP team needs to have. It's not, is this the perfect deal that's not going to have any problems, because it doesn't exist. Right. But does the team have the experience to get through it? Right. And how are they going to handle it? Right. How are they going to communicate when there's problems with the issue? Those are the things that really matter. And I think that's where a limited partner should be focusing their attention on. More so, I think it's more important than the deal. It's kind of like you might have heard, or your listeners might have heard the analogy of the horse jockey, right? So the horse track is the market, right? Let's say you want to go to Dallas, right? So it's the Dallas horse track. The horse itself is the property, and the jockey is the GP team, right? And what do? You got to bet on the jockey, right?
The jockey.
Exactly. I mean, you want to be at the right racetrack, and you got to know a little bit about the horse, but beyond that is really the jockey that's running the show, and that's who you're betting on. So, and it's very true in real estate from my experience, and that's just how the industry is.
Yeah. Really, really well said. I think that's, you can get into, like, there's books that'll give you due diligence checklists on the deal, on the sponsor. And you can obviously deep dive this stuff as much as you want to and check underwriting and, all that stuff. And at the end of the day, as a limited partner, even if you get all that right and you make a call to invest, it still comes down to the GP's execution, and which is the asset management and capitalization and working with the lenders, all the work that goes into owning a property after closing, which has been one of the bigger, like, revelations for us at Greenlight over the last 4 or 5 years is just the importance of the asset management piece. The execution of the business plan is where the rubber meets the road. So you got it, like you say, bet the jockey. I like it.
Yeah, I agree.
Yeah. So, and then what do you say to people that, hey, Chad, you're in this commercial real estate game. Interest rates just spiked historically fast, and we may or may not be in a recession or going into a recession. Like, how's that going to affect the multifamily market, and particularly from the look of a passive investor looking at a particular deal?
Yeah, good question. And that's the $1 trillion question we're all asking ourselves right now. Everyone's got an opinion, and I do as well. My opinion is that there's money to be made in all markets, right? And sometimes it gets a little trickier to find the deal or find the team that can be successful in a given market. But I do believe there's money to be made in all markets. So that being said, I'm still a very active buyer. I was just out in Dallas looking at a property last year that we just got under LOI, and then in Alabama looking at a self-storage property. So nice. We're very, very active right now. I do think you got to pay particularly close attention to debt right now because I think the interest rates are still going to creep up a little bit. And I might be a bit on the minority side in terms of my opinion. I don't think they're going to be lowering the rates. I think they're going to keep them high. Historically, they're not high, right? We're at the 40-year average right now. Right. So it might feel high, but we're not high. I think they're going to stay at this level for a while. I think the Fed is going to have a difficult time getting inflation under control. I think we're going to see these ups and downs in inflation. Right now, we're a little bit lower. I think it's going to go back up again. And they're going to need to keep the interest rates elevated a bit more to try to get that under control. And I could very well see them increasing that. That being said, if I can secure, 5 to 10 year debt, fixed debt on a property today that makes good sense, is cash flowing, then to me that's the start of a good deal, right? Those deals are definitely out there. Like this other property we're looking at, we're buying it at the price it sold for in 2019. So if you were an investor that was kicking yourself like, oh my gosh, I missed the COVID run up, because I was so scared to invest during COVID, and, multifamily did amazing. Well, there's some opportunities to get back in right now at that pre-COVID pricing, right? Yeah. So I think that's a big deal. Tie it to debt, fixed debt. You can do interest rate caps, but those tend to be shorter term and they're very expensive. Renewals are very expensive. So I'm not as excited about that, but it's much better than not having one on a variable rate loan. And you can have, but fixed rate debt, in my opinion, would be preferred. And it's a cash flowing asset, right? And then you weather the storm. So, I still believe the two best times to invest in real estate were 20 years ago and today. I love that. Yeah. In 10 years or 20 years from now, it's not going to matter what happens this year, right? You got to look at real estate as a long-term play. I tell people or investors, if you're looking to make money for your college tuition that you got to pay for your kid coming up in 5 years or 2 years, like real estate's the wrong play for that. You got to be able to sit through longer cycles if you need to. And if you have the wherewithal to be able to do that, meaning you don't need the money in a few years, you're going to end up on the right side of history when it comes to real estate.
Right. So just on that note, do you look at 5-year models, or are you typically a 7-10 plus year model guy?
So it depends on the deal. I've done my shortest is probably a 5-year deal is my shortest and most common. But I've done 10-year deals. I've done infinite hold deals. So I just did a fund last year, short-term rentals, where the plan is to hold it for at least 20 years. Right. And then just refinance when we can, return equity. Return the equity to investors, but keep them in the deal.
Is that paying a pref? That fund?
Yes. Yeah. Yep. And eventually, if we can get investors all their money back, and at some point we can, we don't know how long it'll take, but give them all their money back, then they're still getting returns with having zero money in the deal, creating what Ken McElroy would call infinite returns. Right. So those are that's just an example of projects I'm doing that are, that don't have a necessary end date on them. But yeah, most common would probably be 5 years. And even when you model it, you do have to model an exit. Like if you want to get an IRR or an IRR that means anything, you got to have some sort of exit. Yeah. So we might model an exit, let's say 10 years out or so. Yeah. Even though we're not planning on selling in 10 years, just so you can kind of see what the IRR would be for a given time frame. Yeah. And so, yeah, that's what we do, but it is very project specific on what that length of time would be. And it's always upfront. It's upfront with the investor, so they have an idea. But, if and a lot of your investors will know this, it's not guaranteed that you get out in that time, right? I mean, you read through 150-page PPM, basically the general partners, they're driving the ship. They're controlling everything on that deal, which is why it's so important to trust them. Yeah. One of the components that they're controlling is when the exit actually happens, or just they decide that, right? They might have a target for 5 years, but if the market's really bad at that particular time, like they might not want to sell. They might want to say, hey, let's hold out for 2 more years or 3 more years, sell in a better market and give better returns for everybody. And it's the GP team that's making that decision for everybody.
Mm-hmm. Yeah. Well said. Do you find that, your kind of specialty niche group of investors are the entrepreneurial type, active entrepreneurs? I'm sure that you have lots of other types of investors as well. Do you have any trouble with appetite for the longer holds, or is it even like reverse of that? Do you have more? You find that you have an easier time, kind of getting people comfortable with a long hold, and long to me is relative, right? Let's say 10 plus years.
Sure. I think like anything else, it varies and it depends on the investor.
Yeah.
There's a time in I'd say that in the last 2018 to 2022, you would have sometimes you'd have 18-month or 24-month turnarounds on some of these, right? Like they might've done a value add and they created so much value that they just sold.
Right.
They had 5-year debt on it, but they sold in 2 years.
Happens
right?
so much like up till a year and a half ago.
Yeah, exactly. So some of these deals were cycling through really fast. But, a lot of investors didn't like that because then they got to go get comfortable with another deal very quickly. And they don't like they don't like doing that so often. Yeah. It's fine if it's just one deal, but if you got your money across 5 or 10 deals and you got 10 deals coming up every 2 years, you're doing 5 deals a year you're looking at. It's just a lot, right?
Yeah. Good point.
So a lot of investors don't like it that short. 5 years is pretty common. That's driven mostly because of the debt industry, right? There's a lot of 5-year loans on it. So it's just a natural time to sell. Yeah. So I think investors are kind of accustomed to the 5-year. But then you also have investors that are like, hey, this is a generational investment for me. It's nothing for me. I'll use the passive income from it. I'm speaking as an investor right now.
Sure.
Some investors say I'm using the passive income as it goes along, but I want this to be a generational asset that I pass on to my kids in 30 years. Mm-hmm. So if you're going to hang on to it and it keeps creating this passive income for me, and then there's a big sale in 30 years, I'm okay with that. And that's what they're looking for. Yeah. So it really kind of depends on the investor. I've seen it both ways, but I will say that the 18 months to 2 years seems like it was a little short for most investors.
Yeah. Awesome. Just curious, being in Raise Masters, how long have you been in Raise Masters at this point?
I just renewed for my 2nd year.
Oh, nice. Yeah. Cool. I joined in January at Raise Fest and I've just been thrilled with everything about it. Give us a quick look into your LP recruiting funnel, or for lack of a better, the way that you attract investors, educate investors, and get them set up to look at deals with you.
Yeah, so you kind of nailed it on the head there. A lot of it's the education part of it, right? And the education is a lot of it's education based. Mm-hmm. And the education could be as simple as like we mentioned earlier, hey, I'm an entrepreneur. This is what I do. I don't know anything about real estate. I need to start learning about real estate, like that type of education, which is really starting at the very bottom, which is fine. Or it might be a little bit more common. Someone that's already got some ideas of real estate. They might have invested in some deals before, and they want to learn more about CSQ and what we're doing. So the education is more on the company and the philosophy, the track records, that sort of thing. And which is also still, an educational based approach. So really, you can kind of look at it like a marketing funnel, right? Where you might start off at the top with a big funnel. There's a lot of different people, and then some self-select to want to get more information. Then they self-select to, kind of come down the cone. They might have a conversation with us, come to some of our meetups, all those sort of things, and basically learn more and more and more as they're kind of educating themselves. And that's kind of the process, I'd say, in general of an LP. It's kind of common across a lot of players. I know Greenlight, you guys do a lot of that as well. Yeah. And it's really helping to meet the investor where they're at with their comfortability level, right? Mm-hmm. Some investors can get comfortable really quick. Others could take several years, right? It just kind of depends. And I think it's our job as operators to kind of meet them where they need to meet. And whenever they're ready to jump on, we've got a spot for them to jump on, but they might be on the train for a long time or at the station for a long time rather before they jump on the train. And that's okay. Everyone's different.
Yeah. Yeah. Whatever works. And these are big decisions with big chunks of people's life savings often. So there's never a rush in this process. And I think, you seem to totally get this without having said it, but the relationship aspect of this space and this venture that we're on is like, it's everything, man. It's where everything happens inside of these relationships. And so if you're a good relationship person and, you have some chops around, authentically connecting with people and making a difference and making an impact to them, like that bodes really well, I think, in the multifamily space for sure.
Yeah. And what's interesting with that comment is it's relationship based between, with operator and investor, but also with operator with all the different players, like either on that team or vendors or people that they associate with, right?
Absolutely.
This is definitely very much a team sport. So It's like you and I and Raise Masters, right? That's what we're doing. We're networking and building our relationships, typically like at the GP type level, right?
Yeah.
I mean, there might be some investors in there, but it's mostly at the GP level. And I would say the relationships, both directions, GP to LP or GP to GP or GP to vendor, they're all very, very important in their own ways.
No doubt. And again, just speaks to the critical nature of the quality of that, the person or the persons pulling the strings, right? The active partners, the general partners, because like you said, it's execution of the business plan is 100% dependent on the quality of the relationships you have with property management in particular. And, any, like you said, vendors, construction people, but construction managers, you got to be high level relationship person. You got to like people. I think, you got to really like being around people and sharing ideas and just helping everybody out and just trying to add value, right? At the end of the day.
Totally. And I think just to kind of piggyback on that, one thing I also was pleasantly surprised with in this field is the abundance mindset that so many people have, right? Like you and I, like technically we're competitors. We kind of do the same thing, but like, I don't see us at all as competitors. I know you don't. Like, if there's something I could help you out with, I want to help you out. Right. And I know for most people, they're the same way with me. And I think that's a really encouraging industry to be a part of.
Yeah.
My other industry, I host TV shows, right? So I got a Hollywood agent and I've done a bunch of that type of work. And I'll tell you, man, in the Hollywood industry, it's a, backstabbing industry. It's pretty brutal.
Yeah.
And it's so different in real estate. And it's just such a nice relief to be on this side of it. And have that abundance mindset, I think, is huge. It's something I really appreciate often.
Yeah, that is so well said. I'm so glad you brought that up because it is, to me, a very, very unique quality about this space, this investing space. Like it's even in the single family space, it's not the same. Or, you get into other asset classes and it's just different. There's a underlying culture of adding value in the multifamily space that just like, and everybody know, like, it's not a opinion, it's a fact, right? Like so many of us really thrive on that and appreciate it. And these groups, like, that you mentioned early on, joining a mastermind, like, if you have a 50,000 or 80,000 or even 30,000 to invest, consider devoting some of that to investing in your network. I think in particular these mastermind groups, I've got a small, powerful little mastermind going right now that's growing. And then I'm part of this Raise Masters force of 400 plus capital raisers. And I mean, the Slack channel in this thing is worth hundreds of millions of dollars plus. Like, pretty much anything you need to get deals done is available in this group. And that's really how you need to look at it. Like, that the whole network is your net worth thing is so true. So
totally agree.
Well done. Well, Chad, so just one more time, just so people know how to reach you, CSQ properties, excuse me, guys, which we have linked in the show notes. So you can just click down there. He's got an ebook called Why Entrepreneurs Should Invest in Apartments. So for your entrepreneurial friends, or if you're a closet or overt entrepreneur yourself, this is a great read to download. And then you're on Chad's email list. It's number 1, and you should go out and get on 20. Like if you really want to learn how this business is done, like make that an action step. Like, no matter what side of the GP LP equation you may be on, like getting into other people's worlds and seeing how they are mastering this game and this space is so valuable. So really appreciate all your wisdom, Chad. It's been fantastic. Any kind of like final thoughts on the, maybe particularly on the passive side, but even in general in the multifamily space?
Yeah, I guess the last thing I'd kind of clarify, because you and I have been speaking a lot from the GP perspective, right? And a lot of LPs. I'll share that I'm an LP in a lot of other deals, right? I'm sure you are as well. So for me personally, I operate deals as a GP, but I invest in other people's deals as an LP. One, I don't have to do any work for it, and I get the passive income, which is great. But 2, I also learn how other operators operate, right? And 3, for me, just personally as an operator, like if I want to test out a new asset class or new market, I like to invest there as an LP first, kind of get my feet wet, see what it's like, really, put my money where my mouth is, so to speak. So whatever part of the equation that you're talking about, GPLP, you don't have to stay there. And in fact, you can do both sides of the equation on different deals. Yeah. Like there's a million ways to skin this cat. Yep. And it's a great way to do it. Ultimately, like I just want to be an LP, right? Like to me, that's the whole, if I could just be an LP and live off of that passive income, that's really what what I'm striving for. It takes a long time to get there. I got 5 kids, so my passive income hurdle is pretty high. Yeah. But that's really where I want to get to, and I know a lot of people do as well. So it's not that GP is above LP per se. In fact, probably the other way around. Right?
Exactly. Well, the profit share is always the other way around.
Yeah.
The LPs are always on the majority side of the profit share, at least almost always. So. And it's a great reminder. I mean, the LP position is like kind of where we all want to be when we grow up, right? Like, it really is like just, pole position in these deals as far as you get paid first, you get paid the most, and you're doing essentially no work other than the research you need to make sure that it's a good investment for you. And to your point about investing as an LP, even if you are a GP or want to be a GP, like we've talked about this on the show many times recently, being an LP in a good syndicator's deal that's willing to like bring you along for the ride, include you on some asset management meetings or whatever that looks like, and like keep you in the loop and in the operations of the deal. That is a wonderful way to do a couple things, get your foot in the door in the business and start learning hands-on, but also to start adding to your track record, right? Because you're going to need that when you become, a quote unquote GP or lead sponsor, whatever that looks like to you. So super great reminders there at the end. Clutch, Chad.
Cool.
Really appreciate you, man. And look forward to sharing this episode amongst other people, with our mastermind group. And I think there's just tons of value here. And, I just wish you all the best. And hopefully we can collaborate here together in the future.
Yeah, sounds good, Tate. I appreciate it. Thanks, buddy.
Yeah, thank you. Listeners, thank you. Appreciate you guys as always. And we will see you on the next episode. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.